Since the financial markets consider all the positive and all the negative information regarding the situation in Europe, it is logical to ask, what are the markets telling us now about risk? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Given that Greece has a relatively small economy on the global scale, it's fair to ask, why are the markets concerned about this topic? Financial market fears are mainly centered around the topic of contagion. What is contagion? How do we measure it? And why should we care? If we think of the domino effect in Greece right now, we have a situation where they want to restructure their debt, and they're not pleased with the severity of the programs that they've been asked to implement. Let's assume that things continue to go down the wrong road in Greece. Eventually, Portugal could raise their hand and say, wait a minute, we need help. We want to restructure. We're not pleased with the programs we're being asked to implement. Similar rumblings could then come out of Italy and Spain. The concern relative to financing in the bond markets, when Greece began to ask for restructuring and said they needed help, eventually the uncertainty about a possible default led to a situation where they could no longer finance their debt using the public bond markets. Something similar could happen in Portugal, Italy, or Spain. Think of it this way. If you owned bonds issued by Greece, when the rumblings start, you might want to sell them, because if you sell them, you can avoid being part of a write-down or part of a default. If the rumblings begin relative to any of these other countries, owners of their bonds could also sell them, which causes interest rates to go up. And then even if you're able to access the bond market, you have to refinance your debt at higher interest rates, which obviously causes problems relative to budgets. Therefore, if contagion fears were increasing over the past several weeks, we would expect to see selling pressure in the markets for Portuguese, Italian, and Spanish bonds. When bonds are sold off, interest rates rise. We would expect, when contagion fears are rising, for interest rates to be rising in these countries due to default and restructuring fears. Now we can return to our question, what are the markets telling us now? Have interest rates been spiking or rising significantly in other countries? The answer is no. This is a 1-month chart of Italian yields. The close as of Friday, January 3rd, interest rates were actually lower than they were on June 9th. On this 1-month chart here, you can see rates, for the most part, over the past 4 weeks, have not spiked. They've remained steady. And heading into Sunday's important referendum in Greece, was fear spiking in the bond markets on Friday, July 3rd? The answer is no. In fact, fear was decreasing yields. This is a 1-day chart of 10-year Italian government yields. Yields dropped on Friday. This is decreasing fear about bad things happening. If fear was increasing, we would expect this yield chart to be moving up, not down. If the market felt that the euro was on the verge of collapse, we would expect to see yields rising really across all countries' bond markets. This is France over the last month. Similar to Italy, on Friday, July 3rd, yields were actually lower than where they were on June 9th. Over the past 4 weeks, yields have not spiked. They've basically remained steady. Since contagion speaks to increasing probabilities that other countries in the Eurozone would see a higher probability of either writing down or defaulting on some of their debt. If your fear is that a country like France could possibly default or write down some debt in the future, you wouldn't be buying their bonds. When you think of extremes, what have people been doing with bonds issued by Greece over the last 6 weeks or so? They haven't been buying them and driving yields down. They've been selling them. So there's no fear here that we could see on Friday, July 3rd. This is a one-day chart. There wasn't a sell-off in French bonds. If anything, people were migrating towards French bonds on Friday. This Bloomberg chart here shows a historical example. In 2011, when contagion fears were increasing, you can see there was a sell-off in the Italian bond market. Yields here were sitting at roughly 4% or under 4%, and they spiked to over 6%. That's a big move. We haven't seen anything in terms of that type of magnitude in 2015. As we just showed you, yields on Italian bonds have basically been flat and actually a little bit down over the past few weeks, rather than spiking and indicating fear of contagion. Another piece of hard data that we can look at in terms of changing perceptions in risk is the performance of the S&P 500. Since Greece missed or defaulted on the IMF payment on Monday night, the S&P 500 hasn't gone into maximum risk-off mode and plunged. It's actually tacked on 13 points. It's gone up, not down. A fair argument might be, Chris, the S&P 500 was closed on Friday. Well, the futures were open on Friday. We did not see a massive sprint for the risk-off exits. The S&P 500 futures were basically flat in Friday's session, dropping less than 2 points. Remember, the title of this video is, What Are the Markets Telling Us Now? This is based on facts, not predictions, not opinions. Another surprising fact, the DAX has also held up relatively well. The DAX closed on June 29th before the default or missing the payment on Monday evening to the IMF. Has the DAX plunged since then? No, it's basically gone sideways. It's just a little bit lower than it was here, just fractionally. Therefore, price in developed markets is telling us to try to be patient with our long positions. We'll shift gears here to investor sentiment in the United States. This 77% figure tells us that the American Association of Individual Investors Investor Sentiment Survey, 77% of the respondents can be classified as skeptical because only 22.6% responded with a bullish response. It's a relatively extreme number, and sentiment can be useful as a contrary indicator when it gets out to either bearish or bullish extremes. Now we're looking at an excellent piece of work from Ryan Detrick, posted on Twitter last week. What he noted was the 8-week moving average of the American Association of Individual Investors percent bulls is near the low that we saw in 2009. These charts allow us to put some context around Ryan's tweet. U.S. investors have not been this skeptical since 2003 and 2009. The percent bull readings here in March of 2003 were roughly 25 some odd percent to 26 some odd percent. Very, very similar to the readings that we had on June 18th and July 2nd in 2015. Similar situation. We have extreme pessimism relative to other readings in 2009. 25% and change, 25% and change is very similar to what we're seeing today. Ryan was nice enough to email me the exact dates of those weekly surveys. So this period here has a sentiment reading that is very, very similar to the rare and low levels that were seen in 2015. Did the stock market plunge after we saw those sentiment readings? No, in fact, it was just the opposite. Remember, sentiment at extremes can be a contrary indicator. When everyone is bearish here, it basically says if they were going to sell, they've probably already sold and they're sitting on a lot of cash. This area here is the similar level, similar to 2015. Instead of being a period to run for the exits, it was an excellent buying opportunity. The S&P 500 moved from the 800s all the way up to roughly 1160. You may be saying these periods are nothing like the present day. We understand that. However, we didn't pick these periods. The data picked these periods. The reading here hasn't been that low in a long, long time. The reading that we have today hasn't been this low since this period here. So the periods that we're looking at, we didn't pick them. Sentiment and the hard data picked them. How did stocks do in a similar sentiment period from here? This is the period in 2009 when sentiment was similar. Did stocks plunge? No, in fact, they did just the opposite. When sentiment was decidedly and extremely bearish, similar to what we have today, stocks did not perform poorly. They did very, very well. The S&P 500 moved from that Damien low of 666 all the way up to 1175-ish in early 2010. We showed earlier with the bond markets in Europe that fear of contagion is really not something that's evident. Let's cover some of the fundamental whys. This is a quote from Reuters on June 17th relative to volatility in the markets. The volatility will no doubt continue in the coming days and weeks, which turned out to be true, but another sovereign debt crisis remains only a distant possibility. Why? The euro area has the tools to prevent another explosion in bond yields, even if Greece were to leave the eurozone. The market will ultimately decide in the coming weeks whether or not the eurozone has the proper tools in place to prevent contagion, and we'll keep an open mind about that. But let's cover some of the fundamental differences that we have today. In 2015, unlike 2011, 80% of Greek debt is basically owned by pseudo-public institutions, either European governments, the IMF, or the ECB. Why is that important? If Greece defaults, only 20% of the debt is in the private sector, meaning the hit to bank earnings and the markets and valuations will be quite a bit less than we would expect or what it was in 2011. It's not good if they default here, but it's quite a bit different when these institutions have to take a loss relative to a private bank taking a loss, where then you can get somewhat of a cascading effect from one bank to another. Europe has known for some time that it's possible that Greece could exit the euro, and therefore they have taken steps to try to put the tools in place to try to minimize the probability of contagion. One of the massive differences from 2011, when we had problems in Europe, in 2015, is the ECB, which is basically the Fed in Europe, can buy government bonds. So if we see a sell-off in Spanish, Portuguese, or Italian bonds, a big buyer, the ECB, could step in and start buying bonds to try to stem that contagion risk and fear. The market knows this, and they know that if you sell your bonds, you're basically betting against an extremely powerful buyer. The financial markets always sniff out vulnerabilities, and they sniffed out the vulnerabilities in Europe in 2011. The markets knew that Europe didn't have the tools in place to try to stem contagion, and thus fear spiked and forced them ultimately in October, November, and December of 2011 to take some action. So in 2011, that was before the tools were in place and before Mario Draghi's famous, "The ECB is ready to do whatever it takes to preserve the euro." And believe me, it will be enough. So the resolve is there and the tools are there, neither of which were the case in 2011. The purpose of this video is not to state that there aren't real risks to U.S. stocks and risks to the situation in Greece unraveling. It needs to be monitored and respected, and we have been and will continue to do that. But we also want to point out, and TMF Housel tweeted this, you can find him on Twitter, here to remind us that not every single event or crisis evolves into Armageddon. USA Today, September 2013, a Lehman moment title to an article. 2014, Lehman moment. February 2015, has the Lehman moment finally arrived? March 2015, a Lehman moment. April 2015, a Lehman moment. So fear is high right now and risk needs to be respected. But we also have to understand that fear has been high in the past and we haven't seen a Lehman moment, which basically refers to the going down or allowing Lehman Brothers to fail in 2008 during the financial crisis in the United States. Before we move on to the present day S&P 500, I want to make it abundantly clear how we use this analysis. This analysis is based on the knowns as of Saturday, July 3rd. The charts that we have shown will change when the inputs change. We use charts to monitor and adjust rather than forecast and hope. The situation in Europe calls for maximum flexibility and contingency plans for all outcomes, bullish and even extremely bearish. We'll head into next week and into the referendum with no bias. We'll be monitoring the charts, and if we need to adjust, we will do that via the contingency plans that we already have in place. If you'd like to see these charts a little bit more closely, this is a tweet from June 30th. You can find it in our Twitter feed by scrolling down. This is an example of 2011 versus 2015. 2011, the market knows that Europe is vulnerable. You can see this is in February of 2011. The stock market in the United States does not plunge until late July of that year. So in February, several months before, gold, this is a weekly chart here, clearly starts to outperform stocks. This rising ratio of gold to the stock market in 2011 speaks to systemic fears and fears about paper currencies. How does the exact same ratio look on the exact same time frame in 2015? This is fear. This doesn't look like fear right now. Like all of the other charts, this is subject to change. But we base our decisions upon observable evidence and facts. So if it starts to change, we will acknowledge that and make the necessary adjustments. With the exception of a few hours in the afternoon in the United States on Monday, June 29th, before Greece missed the IMF payment, price action has been very, very strong relative to the news that was out there. The market's big fear is not necessarily that this situation drags on. The fear is related to Greece possibly leaving the Eurozone and then contagion picking up. So if they have to go back to the negotiation table and they're making progress, the market can probably look the other way. The more contentious things are, and the higher the probability or uncertainty relative to Greece staying in the Eurozone, the higher the probability that we move back to that Monday afternoon price action on June 29th, which is a fearful look. Regardless of how Greeks vote on Sunday, polls have been consistent. Most of them want to stay in the Eurozone. The market understands that, and if the market believes that eventually things will get worked out and Greece will stay in the Eurozone, then the odds are pretty good that volatility will calm down as well. We won't spend much time on the present-day market. Why? These charts could change drastically based on what happens in Greece on Sunday and Monday. They could get much worse or much better. Right now, the weekly chart of the S&P 500 is telling us to respect downside risk if support does not hold. Now we have a lower high and a lower low and a full-bore bearish look on this faster read of the markets using these moving averages. If we use moving averages with a little bit longer duration, you can see we've got some slopes down here, but we don't even have one bearish moving average crossover. When risk is high here, blue is on the bottom and all of the slopes are down. We still have blue on top. So this is telling us that momentum is slowing and risks are increasing. And if support breaks, we have to respect that. But for now, blue is still on top here, and it still looks more like this period here than this period here. For clients, in terms of our specific game plan, and anyone can find this video, just understand it's for clients. We don't know anything about your particular needs or situation. You could probably Google this title or Google short takes and my last name, Shavako, and you can find it. It was dated June 28th. The concepts still apply because support did hold last week. This is the chart as of the close on Thursday, July 2nd, which was the last trading day of the week. So this is the end of the week look. We should also point out, remember way back on May 29th, think of all the bad things that have happened in Greece since May 29th. On May 29th, we said our concerns would increase if we break 2067, 2064, and or 2039. While we did take out some of these levels intra-week, we were able to close above all of them last week at 2076 and change. This intra-week low of 2056 is relevant. It tells us that we still have to respect bearish outcomes. So we'll let price guide us as we've described in the past heading into next week. The purpose of this video is not to predict anything about what's going to happen next week. It's just to show what we know factually heading into next week. In this video, we have shown that price, the S&P 500, has not broken support. The DAX has held up relatively well. The observable evidence in the bond market in Europe is not screaming contagion fears, at least yet. Sentiment is extremely bearish, which tells us to keep an open mind about better than expected outcomes. Our analysis, recent analysis on fractals and recency bias are also still relevant. You can find the analysis by Googling this title. Another relevant factor to keep in mind back in the United States, based on 30-day Fed Fund futures, the market as of last week is saying there's only a 12% probability that the Fed will hike rates in September of this year. Since markets set asset prices, it's the market's perception of risk in Greece that matters rather than our personal opinion. Therefore, if Greece leaves the Eurozone, the market will determine the significance or lack thereof. If they stay in the Eurozone, the market will determine the significance of that or lack thereof. We'll keep a flexible, unbiased, and open mind as we head into next week and use the charts, if needed, to monitor and then adjust. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.